All right, so take another look at the stock market. I think we've probably found our initial bottom. We may have one small undercut. I'll explain here in a minute. Um, we're starting to get these violent back and forth swings. This is typically a common bottoming pattern at an intermediate cycle low. Um, the market will just, we'll get these big 3 and 4% swings back and forth uh, as the market tries to hammer out a bottom. The bulls always eventually win this battle, but we may undercut this slightly. And the reason why is that this daily cycle is still fairly young. I think we're going to be on day 28 today. We did get our ABC pattern. I talked about this in the last several videos. An intermediate decline should form as at least a three-wave pattern. Got your A wave down, your B wave bounce, and then the C wave undercuts. We've got historic um, oversold conditions, and they've happened in a historically short period of time. This is kind of very similar to 1987. You're going to see a lot of perma-bear analysts calling for a new bear market. This is not going to be the case. Um, at some point, the market will start to price in that the coronavirus will die out and go away, and the world economy will get back to normal. Again, no different than what happened in 1990 when we had a recession during that bull market. And obviously, the crash in '87 looked like the beginning of a bear market. And while technically it did register as a bear market because we dropped 35%, obviously it did not stop the secular bull market. That still had 13 years to go. And we've still got at least 10 to 15 years to go in this bull market as well. So, since there's no fundamental change like there was um, in 20, the beginning of 2019, when the Fed stopped its rate hiking policy and the market just took off like a rocket and just kept going higher and higher. That there's not going to just all of a sudden the coronavirus isn't just going to disappear. So I doubt that this bottom is going to form like that, where we just take off and run to the upside. Um, it's probably, and based on what the futures are doing this morning, it's probably going to be a violent back and forth chop here. Uh, my guess would be into the FOMC meeting, and if the market is still, trying to chop out this bottom, then the Fed's probably going to cut another 50 basis points, and then we'll get a sustained rally in the stock market. You can see on the bullish percent chart, this is a measure of market breadth. We've hit levels um, not seen since the financial crisis, and we're not in that kind of um, condition or environment again. So we've got oversold conditions more extreme than any other time during this bull market. This is not a time to be getting bearish, although most dumb money traders, this is when they become most bearish. And I'll show you a sentiment chart that will prove that here in just a minute. As a contrarian traders, I've said this many times, we want to do the opposite of what everybody else does, because at major turning points, everybody else is wrong, and we end up being right. This is the new highs minus new lows chart. You can see even more extreme than the crash at the end of 2018. The only other period in time more extreme again was during the depths of the recession and financial collapse in 2008 and 2009. And again, we're not in this kind of environment right now. All right, and this is small trader put buying. They're making bearish bets, and this is dumb money. What are the odds that these emotional traders that are always on the wrong side of the trade, these are the people that we want to be contrarian to, when these people all get on the same side of the boat, we want to go to the other side because they are always wrong at these major turning points. And you can see they are more bearish now than even in the depths of the Great Recession. So this is what I think is going to happen. You can see here we've given back at least half of yesterday's rally. I expect this is going to continue. We're going to just get wild whipsaws back and forth until probably the FOMC meeting, and then we'll either marginally undercut this, which will of course get the dumb money traders very bearish. They'll short very heavily, and then they'll get caught because we have completed this leg of the 4-year cycle low, and that's what this is a 4-year cycle low. We've completed this leg with the possible exception that we might slightly undercut this maybe next week or Monday or Tuesday of the 23rd, simply because this daily cycle is still a little bit young. Like I said, we're only on day 28. We usually don't get a bottom till day 35 to day 38, so that would put us out into next week or the beginning of the week of the 23rd. So it's possible that we swing violently back and forth, and then we get a very marginal undercut of this of Monday and Tuesday's low. That gets everybody bearish, and then the market reverses, catching all of those people holding the bag, and then you get a massive short squeeze where all of those shorts that piled in at the bottom have to cover, and the smart money will have covered their shorts on that undercut, and they will be positioned long, and then we'll get a nice rally. All right, but this is what I think is in store. Most 4-year cycle lows tend to get a retest and very often an undercut before they're over. I'll show you the weekly chart here in a minute. We have not come down far enough to tag that 200-week moving average yet, and I think a 4-year cycle low really should. So what I suspect is going to happen is we're going to get a convincing rally. This particular intermediate cycle, remember this began back in May, this has 5 daily cycles embedded within it. Usually a long cycle is followed by a short cycle, so this could either play out as one daily cycle, but I think that's unlikely. I think it's going to play out as 2 daily cycles. So we'll get a very convincing first daily cycle up, and then we'll get a second daily cycle that left translates, and we come down, break this low, and probably come down to tag that 200-week moving average. So my guess is end of May, sometime in June, we get our final 4-year cycle low, and we drop below this low. And I would say a different driver, fundamental driver for this decline than this one. This is obviously being driven by the coronavirus scare. It is going to, almost certainly is going to cause a mild recession, but completely different type of recession than the normal. Normally, oil, big spike in oil collapses middle class spending. We don't have a collapse in middle class spending right now. We don't have anything to trigger that. We probably just got people that are going to be nervous and are going to, lock themselves in their house, not go out to restaurants, not spend money. But they still have plenty of money to spend on Amazon and such. So this would just be a mild recession, driven by the people staying home, more or less. Not because their finances are constricted by cost of living spike, and they just don't have any money to buy anything other than food and gas. Completely different driver than what normally drives recession. So at some point here, the market is going to start, come to its senses and realize that the coronavirus is eventually going to die out, and the market will bottom long before the fundamentals turn on the virus. And and again, people will, dumb money traders will be scratching their head. They won't be able to understand how the market turned when the news has not improved on the virus. But the market will discount that. It will, figure out long before it happens that the coronavirus is going to peter out, and and then we'll start to get back to normal. So I expect a different driver here, probably something to do with the repo market. So more of a financial um, crisis on this leg down. So, I think we're getting pretty close to a sustainable rally. I noted the other day that the VIX had spiked above 60. The only other time we'd seen more panic than that was in the depths of the Great Recession. So we've probably squeezed about as much panic out of this market as we can. So other than what I expect to be some very choppy trading here for the next week and a half, we're probably done about all the damage we're going to do during this particular leg down, and we're setting up for what should be a pretty decent, at least a tradable rally, and then this intermediate cycle should left translate, and then we should move down. And let me show you the weekly chart. All right, here's the weekly chart, and you can see we're just going to come up a little short of catching this 200-week moving average. So I think we probably got one more leg down. You can see this 4-year cycle low. You can see this double bottom here. I think the same thing is going to happen here. We're going to get a little bounce, and then we'll come down and make a double bottom with an undercut, something that it at least comes down to tag this 200-week moving average. And then if I widen the chart just a little bit more, you can see the 4-year cycle low here in 2011. The same thing happened, a slight undercut after a bounce. So I think this 4-year cycle low is going to form the same as this one did, and this one with the undercut. So at some point here, we should get a convincing bounce. Definitely a move back above 3,000. Maybe we even come up and fill this gap here as the coronavirus scare fades away, and then the next crisis unfolds again, which I think is probably going to be in the repo market, and that drives the second leg down of the 4-year cycle low. And then at that point, I think we're done, and I think that's going to be your single best buying opportunity for the next 10 or 15 years.